So I want you guys to be at these as much as you can. Each week, we're trying to do something a little different on theme. So we are training on certain pieces of the puzzle each month a little differently. So this month, we're talking about controlling the deal, components of the deal that matter, that we need to be experts on, that ultimately will help us get more deals done, keep more deals together, and feel confident in our skill sets. Right. So next month, we're going to have a whole new set of focus. Right. And so I want you guys to just understand that we're trying not to regurgitate the same stuff, but we're trying to bring experts into the room. So today we got Matt on here. And so we're going to be doing kind of a workflow, because behind the deal, we look at real deals. And so we're looking at some real components of the deals, but we're going to try and compress the entire deal to now, because sometimes we need to be able to negotiate knowing what could go wrong 30 days from now, right? We need to be able to negotiate our inspections knowing that we still have appraisal around the corner. What could that mean for us? How do I need to approach this maybe differently or whatnot because of the scenario we find ourselves in? Because I think the experts, the ones who do this the best, they see all the pieces on the chessboard, right? Like, not your move, but the guy's, your opponent's second move, right? If he does this, then I do that. And so that is how these negotiations need to go. We're not trying to gamify these things. We're just trying to say, like, he who has the most information typically will win. Okay. And we can set our buyers' expectations better if we are seeing things further downstream. Okay. So we're going to talk through kind of a generic scenario. We're going to talk about it at the beginning, at the inspection point, at the appraisal point, and then, hey, what happens when the guy has a financing issue that comes up and he takes out a car loan before closing, and how do we deal with those situations? So we've got Matt here too. And what we want to do is contrast. Let's pin Matt up here. What we want to do is we want to contrast price. We're going to kind of lace this throughout: price versus concessions. Okay. When I say concessions, I'm meaning seller paid closing costs. Make sense, everybody? Seller paid closing costs. Buyers love to get closing costs paid for them. Jess, can you see a screen share approval? Well, while we're waiting on that, we'll kind of lay out the kind of the general framework of this. So let's think we're going to do some things for easy math. And then what I want from you guys is, if there's a scenario that you've actually dealt with as we get into different parts of this, I want you to raise your hand and we'll talk about it, right? Real specifically. Because I want us to be able to flush out. I learned these things by like working the numbers 6 ways from Sunday, right? And then you're like, oh yeah, that makes sense. I can carry that into my next deal and it's easier, right? Because sometimes we find out there's only so many ways to skin this cat. There's only so many ways to break down concessions versus price, and the impacts carry pretty well throughout. So let's work on and I know Matt's got some scenarios pulled up. I want to talk about it in an overview standpoint first. We've got a buyer that's buying a $500,000 house roughly, and they really want some closing costs. Okay. What is generally the max closing cost? Let's say they're putting 20% down. What is the max closing cost or concession they can get from that seller?
It's going to depend on the loan type always. Before I tell you the answer to that, I want to plug the kind of cheat sheet that I've created, because this information isn't necessarily something you always have to just remember off the top of your head. That's why we provided that cheat sheet, so that you have the ability to see those things and figure those things out. And of course, if you can't remember and you need to shoot me a text or give me a call, that's 100% okay. But the amount of seller concession a borrower is allowed to get at any given time is going to be dependent on their down payment percentage and the loan type. And it is, in this case, so if we're looking at a conventional loan and the buyer's doing 20% down, they're allowed to get 6% towards their closing costs, 6% of the purchase price towards their closing costs. And that's the most that they can get. Anything about outside of that will be rejected. And if I'll just give you the other ones. If they're doing, 5% or less, then they can do 3%. If they're actually doing 25% or actually more than 20% down, you can get up to 9%. And so it really is going to be a function of the down payment percentage on conventional loans. HA loans, a little bit different. It's 6% regardless across the board. So it doesn't really matter how much they're putting down. It's going to be all about just in that case, the loan type.
Let's assume this scenario: 500,000, 20% down, meaning they could get up to 6% towards closing costs from the seller, right?
Hmm.
Which
Hmm.
equates to $30,000. If
Hmm.
I follow 500,000 times 6%, $30,000. How much is the loan going to cost them? Like, what kind of closing costs roughly are they going to have on this loan?
So 500,000 purchase price. We're doing 20% down on a conventional loan. Okay. If we were to do nothing, and there's no seller credits, no anything. If we go over here, this is kind of where kind of the fees happen. So it's going to account for, loan fees, appraisal, credit report, title insurance, and the different government fees, setting up escrow accounts, your prepaids, and then the title policy, owner's title policy. But for a typical, if the seller was not paying anything and not contributing towards the title policy, which is very common, even if they don't give seller concession, they generally still will pay for the title policy. But this shows you, you're looking in this scenario about $21,000 total in closing costs. So when you add in their 20% down payment of 100, you're looking at now total out of pocket 121,000, a little over 121,000. Now,
Everybody follow?
uh,
So I want y'all to see this, because this is really the kind of the behind the scenes on how, when a loan is structured, built, qualified for, exactly how it is done. Certain things are subject to change, right? Each property has its
mhm.
own little variables, but in general, this is going to be pretty spot on.
I will say a couple of other variables that change things obviously are going to be credit score. So we're using a 780 credit score here. Um, then DTI definitely has some effect to it, but that's not going to be super important. And then this is kind of where the payment itself is broken down. So we got the P&I portion of the payment, and this is actually live pricing, by the way. Rates went up again this morning, just so you know, but the par price essentially is going to be about in the upper sixes right now with this credit with 20% down. So that would make a payment, P&I payment of about a little over 2,600, and then we estimate taxes and insurance. There's a mortgage or association HOA. We add that here. This obviously, since there's 20% down, no mortgage insurance, so their total payment is going to be here about $3,350 in this scenario, with 121,000 out of pocket.
All right. So scroll by. So we have 21,000. So we're talking roughly 4%, right? Versus 3. Again, these are always loan dependent, credit score dependent. It is to have a general figure.
Hmm.
Quick quiz question. As the purchase price goes down, what happens to our closing costs as a percentage of our purchase price? Any guesses? Typically, we're going to see them increase as a percentage. And the reason being, just think about it. There's a lot of things in here that are fixed costs, right? Flat fee costs are not based on the percentage. So as you go up, you might even get lower, right? We go to a big jumbo loan, we might see that total number of closing costs diminish as a percentage.
Hmm.
All that to say, we're talking in this scenario. Let's say Dylan negotiated this deal, 500,000. He came back and said, Matt, I did it. Negotiated 6% towards my buyer's closing costs. So let's go plug that in. Dylan's so pumped because these buyers wanted to make sure they had everything covered, and we're going to run it this way. So we're going to run it with 30,000 in seller credit.
All right. Now, obviously, you can assume, and you can assume you'd be assuming correctly. This is a dollar for dollar. If you notice, we add 30,000 here on the seller credit. The cash to close amount went down by $30,000. So we're talking dollar for dollar change in this. So in this scenario, right, I think it ultimately also is going to boil down to each borrower specific scenario. Sometimes cash to close to them is not important. They're more concerned about payment. And that's going to be something that you're going to have to kind of, and I do as well when I talk to them, have that in mind when you're negotiating. Like, what is more important to them? I would say most people want everything. They want both. They want low cash to close and the best rate and the lowest payment, right? But there's always going to be some sort of middle ground. And then one other thing I'll just say, so we're all on the same page. Keep in mind, this is what I tell just about all my buyers, especially my first time home buyers. The relationship between closing costs and in turn out of pocket and interest rate is an inverse one. So as one goes down, the other one goes up, right? So, lower interest rate, you buy down the interest rate, your closing costs go up. So just that's obviously very intuitive. Most people kind of understand that, but sometimes I do have to verbalize that to the buyers and just say, look, we can play with the numbers, but just know when we do one thing, it's going to affect something else. And it's usually the opposite direction. So as rates go down, costs go up, or costs go down, rates go up.
So one thing I want to understand here. So we talked there was $21,000 in closing costs. We've negotiated 30. Where does the other 9 go? What do we do with that?
What do you mean? The other nine?
Go down to the bottom because we only had $21,000 in closing costs.
Yes, that's a good point, actually. So in reality,
Where
there.
this everybody gets to a stopping point when you negotiate
Mhm,
without having a lender conversation. We had
mhm,
this recently. A closing was balanced with title. They're like, "Oh, we can only use X percent of the closing costs we've negotiated." Right? What do we
mhm,
do?
mhm. Well, so and this is actually very important, because a second ago I said yes, you can get up to 6%, right? And so you can maximize what's allowed at 6%. But in this scenario, what happens when the closing costs don't match that? So what would happen if we didn't do anything is that this 30,000 pays off a big chunk of it pays that off. And then what would happen is that it would bring down the cash to close below the down payment amount. That's not allowed. And so essentially what we would need to do in this scenario as a loan officer is that I would now go and start looking at changing the rate and adding costs to the loan to soak up that, $8,400 or whatever it is, so that what it really will show is their cash to close amount is going to be as close to 100,000 as possible, because that is their down payment. If we didn't do anything, then that seller credit would now start to eat into their down payment. And what the underwriter would say is like, now the seller is helping them with their down payment, right? That's not allowed, right? And so that's why in this scenario, we would need to go in, and I'll show you kind of how that works. We run pricing. And so we'll just go with PennyMac, for instance. So I know that right now 6.875 is only a cost of about $240, right? So what we need to do is actually soak up about $8,600, right? So in this scenario, like they would in turn use that money to buy their rate down, probably closer to this 6.25 amount, because I don't even think 6.375 would do all of it. Although I will say it kind of depends, because there's a big jump. A lot of times what you could do is, negotiate, a longer home warranty, or something like that. Like, where we're talking a couple $100, we can always add fees. But in this case, we can just kind of go here, because I don't want to make it too much more. We're talking about $1,500, and maybe they only want to come out of pocket their down payment amount, right? So we'll apply that, go back over here to review fees, and we'll show you what it's done. So we're actually in this scenario, yeah, we still haven't used it all, because this can't be below 100,000. So we would need to maybe add, something here, and again, we could collect more in taxes. A lot of time that would soak up some of that. And there's different ways we could do it. So that's kind of the name of the game here is when you're maximizing the seller credit and there isn't enough closing costs to do that, the next play there is to buy the rate down.
Right. Yeah, and that's what I wanted to make sure we hammer on because it's important that we have that understanding. If we're trying to, what is the goal of the buyer, right? That is ultimately the objective. Is like, what is what is that 6% in their mind being used for? It can never be used for down payment, I guess, except in a that we get in these only time it gets into a weird spot is if it's not financing. If it's cash, what's the difference in reducing price and a concession? It's effectively the same thing, right? So
Mhm.
we're this whole conversation is around finance transactions. So let's assume we negotiated that. Dylan negotiated a great deal, 100. We are at 20% down. We've got 6%. We've lowered our rate down to 6,375. We've got a couple $100 to play with for, some prepaids or other things. And we go into inspections. We get to inspections and Dylan comes back and says, "Man, he just told me about this story yesterday. Roof's bad, electrical's bad, plumbing's bad. All of these things got to be done. We think we've got about 20K and things that have to be done to this house for us to be able to make this thing happen." Okay. So you've already negotiated your deal. So and we're going to talk about just the mindset, the framework of how we assess these different scenarios, because every one of them may have impacts on what? On the loan, on the structure, on the buyer, on their ability to fund some of these things or not fund some of these things. So we come back to the table and Dylan's got 20,000 he's got to play with. He's either got to get the seller to make repairs or he's got to get them to negotiate some maybe concession for you to be able to do it after, right? So walk me through as we're talking through this. I want to hear from you. I want you guys to thought experiment. Like, what are the scenarios in which we can play? We already have this deal negotiated. What can happen from here?
Could you use, instead of buying down the rate, could you use some of that closing cost to cover some of the fixes?
Sure, maybe. Sure, maybe. We got to figure, and that's part of the question we're trying to figure out, right? We've already negotiated that, so we were good at that. Now we've got a wrinkle in our deal. We got to come up with, let's just say it's $20,000 worth of fixes.
Mm.
Sure. I mean, this is happening to me now. The property we buy has so much work to be done, but it's also a gem, right? It's like five people, put an offer in it, cash offers, and the deal can that went pending and it came back active because the people did not want to invest the money to fix the property, right? And then they came back and like, so my buyer has a brother who's a contractor. He goes to look at the property. He said, "This is just maintenance, This is little things that we can fix ourselves, blah, blah, blah." We asking for the roof to be fixed, 20, like 15,000. It's a small house and a few more things. So basically the buyer is just giving 15,000. We put out for full price. No, 10,000 more than they were asking price. And she's getting the house. And, sometimes it depends. Think like in this situation, I felt like I was doing an awful job. Like I was not getting enough for her, but it was a jam, as multiple people wanted this property, so she needed to do that.
And so it's a good point because a lot of times we find ourselves at a place where, let's just say in this scenario, the buyer wants the house. Okay. So let's worsen this, right? So we got the roof issue, we've got plumbing issue, we got an electrical issue. They cannot get insurance. They've got to have the house insured to be able to fund it, to be able to finance it, right? So we've got to figure out a solution. So what we're trying to do is say, buyer wants the house, they like it. If those things weren't an issue, they would close anyways. We just have to, and they've got only so much cash to come up with. They got 100 grand to put down on their loan, right? And that's really where we're trying to get them. It's 100,000 in. We need the other stuff accounted for as a part of our deal. How do we do it? So let's go with an obvious one. What's the first obvious request we could make?
To me, like I did, like the big items to be insurance approved, and she really wanted the house as plain. You need to have the roof replaced and the cut wire. The main two things they're gonna stop you if you get insurance, and they went for it. They just said, "Okay, great, we got a quote," and they decided the
And
big
so
item we replace.
the seller's doing those things.
The sellers doing this.
Got it. So yeah, I mean, that's a first option right out of the gate. Sellers doing those things. What do most sellers say when you ask for that?
I'm already giving you so much money.
Yeah, we already negotiated. I'm already giving you $30,000 to cover your closing costs. Like, we knew this house wasn't perfect, right? Buyer still loves the house for the price. Now we're trying to figure out how do we actually get them to be able to close.
Yeah, I guess go with the what happened at our last meeting, in-person meeting, where Ricky was like, well, that was under the assumption that the house was in, perfect shape. Now we have this report. Now, I mean, I like the idea Omara was saying, like maybe go up instead of going at their listed price, maybe going up and then trying to have the loan kind of cover the cost, but to try
Good.
to like borrow the money and then you just push it down the line.
Okay. What are the impacts of raising our price? What are any other added risks into that scenario?
But their
Matt?
closing costs. Sorry.
Was it? Yeah, no, you're good.
Yeah. No, I was the biggest
Yeah.
risk, and I think this is where you're going, is, what happens if now the house doesn't appraise? Because now you're buying it for a more expensive price, and it would have appraised at the original 500,000, but now you're going up to 510 and it appraises back. It appraises for 500, but you're buying it for 510. That's a risk, because in that scenario, then your buyer either would have to cover the difference or the seller would have to bring the price back down. But it kind of starts renegotiations again.
Yeah, and for my defense, that they had done a appraisal already, and the house appraised for more, so it was a
There you
good.
go.
Yeah, I mean, sometimes that happens. It is something we need to think about, though, right? If we're trying to build more in and stack it on, what happens when it doesn't appraise? Are we delaying the inevitable cancellation? That we're not ever going to be able to make this work. Kravinsky, I think you were going to say something.
I was gonna say if the interest was gonna go up, but my already inside is gonna be the appraisal.
So the buyer in this scenario is happy with they're happy with their cost to close. They're happy with their monthly payment, all these things. We got to figure out how to circumvent this issue. Any other creative ideas? Let's say, and let's just split the baby here. Buyer or seller says, "Hey, we see you got 20K in issues. We'll contribute another 10. Like we want to get it done too." Everyone is on the same page that we want to get this done, right? Sometimes we get there. Buyers happy with the house and the price, sellers ready to be done. We're just trying how to figure out how to get Matt to figure this thing out for us, right? Because the buyer only has so much cash they want to buy it with. Seller's willing to come down to a certain number. Everyone's going to have their limitations. What other scenarios do we have in our back pocket here?
The agents can get involved and maybe try to help finish the difference if the commission is
Ask
there.
me to do that as the buyer agent. Ask me to do that.
Oh, would you want to go down to split the difference to make this deal go down?
I'm not making enough to split the difference on a roof. I mean, like if the first pass ever is me fixing that issue, like I'm sorry, like our gross commission's 15. How am I gonna fix a $15,000 gap? And as the listing agent, I'm gonna just say pass. We'll sell it to somebody else.
Yeah.
So no. So let's think about that much later. I'm here and ready. Most agents, hey, if we're talking about $500 issue we get to, let's talk.
But I think it's important too to, that conversation should only be happening if there's no other options, right? If we've already hit, the seller's limit, they can't go down anymore because, they've got a loan to pay off or they need a certain amount to buy their next house. That's one limitation. Obviously, the loan itself will create limitations that they can get, whether it be because you're already getting the maximum seller contribution or whatever it is. The loan itself could have limits. And then, of course, your buyer obviously could have limits as to, I don't have any more cash. You know what I mean? This is the most that I have to have. And so I think in every one of these different scenarios, we look at each one of those things to see where there's somewhere to give. And it's only when there's nowhere else to give, I think that the realtors would need to or could look at figuring that part out, because that is essentially a cost reduction is what y'all would be doing to be able to do that. And really all that would do is free up more cash for the seller to make the repair themselves. But I also think it's important to understand, of that 20,000, that's being asked for, how much of it is non-negotiable, whether it be because, maybe 10,000's for a roof, and then the other 10,000 is kind of for stuff that I can, you can fix or whatever. Because as we've talked about a couple of different things, there are insurance things that will come up where that has to be fixed or my buyer can't get insurance. Okay, so we know that's a non-negotiable, that needs to be fixed. And then I would say there are also appraisal considerations, because if an appraiser goes out and appraises it, and let's say it does appraise for more or whatever it is, but let's say that the appraiser calls out something, right? That also has to be fixed before the loan will close. Now, everything else could be that, okay, well, maybe I'm the buyer, I can get it fixed afterwards. We'll take that one off the table. But it all depends on kind of the things that have to happen versus the things the buyer wants to happen. And I think it's important to even have that conversation with your buyers that you can't buy this house unless that's fixed, versus yes, you can still buy that house. You'll just have to maybe get that fixed yourself or do that afterwards.
So let me ask because I want us to get really creative here. We've got a deal structured. We've got 20,000 to account for. Sellers willing to put forward 10. We've maxed out our closing costs. I need to use that money to repair, roof and electrical, all these things. I'm looking to come up with some extra money out of this deal. I don't have it to bring. Trying to figure out where to get it. Okay. So what is the other? Insurance is obviously something we need to check, right? Two things you guys hear me all the time when we get to these points and deals. What's the first one? I'm just curious how y'all are doing memes about me yet, because I feel like I'm like a robot sometimes with some of my questions. First one's, what's it worth? Hey, we're negotiating this deal. Cool. What's it worth? Oh, I haven't run numbers on it yet. What? Okay. Because that helps answer the appraisal component. You tell me it's worth 600. We got a whole different set of options right here, right? You tell me it's worth 490 to 5, we need to be a little concerned about how we structure this. 2, you've done through inspections. Have you had insurance quoted yet? Do you know what your parameters are that are required to happen before closing and what can happen after closing, right? Those are 2 very important keys. Like if you're playing chess, that's like an opening move, right? Like that's to start this conversation, we got to have those things answered, okay? So let's help us get creative a little bit. Let's assume we can do these things after. We got 30 days after closing. Insurance says we'll give you 30 days to fix all those things. How do we place this $20,000? Actually, we got to come up with 10. We got to figure out how to place their 10. Follow? Any ideas? Where's money coming from in this transaction?
Purchase price,
Where's it coming from to hit the purchase price?
the lender.
There's always 2. Yep, the lender and
The
The
buyer.
borrower.
The buyer.
the buyer. Yep. Can I change that ratio at all? Right now we're at 20-80, 20% buyer, 80% finance. Matt, can you run a scenario for me where the buyer brings 15% on this loan?
Absolutely. So yes, and I was holding my tongue because I wanted y'all to answer it, but yes, if there's two parties involved here, the lender's one and the buyer's the other. Now, in this scenario, they are not putting the minimum down payment, right? They're putting 20% down. They don't have to put that much down. Nobody does. Now, again, sometimes the debt to income ratio dictates how much they have to put down, but in this scenario, we're good there. So, okay, well, Mr. Buyer, let's do 15% down, right? Now, of course, the first thought there is, okay, well, we do 15% down. Now, all of a sudden, mortgage insurance is going to be in play, right? And they wanted to avoid that. My question to them in most cases is, okay, I get why you want to avoid it, but in terms of it's an extra cost, but what are you thinking that cost actually looks like? And then we kind of go, hold on, let me do this. And then the conversation becomes, okay, well, it's obviously a monthly payment, but how much is it monthly? So in this scenario, the rates came out and they're worse. Here, we'll just do it like this one.
Since we started.
Yep. We're down 70 basis points now. Okay. So in this scenario, same interest rate, 6.87. Actually, was it? Oh, yeah. Let's go down to, they were buying the rate down.
Yeah, use our
And
roughly 9. You go to that 625.
yeah, we'll do that one. Okay. We'll apply that. Now, all of a sudden, borrower's cash to close went down, $20,000 ish, more than 20,000. And we're looking at $38 a month in mortgage insurance at 15% down. Now, the question becomes to the buyer.
Our rate went down too from 6.375 to 6.25.
Mhm. Yeah. So, I mean, and ultimately that's important because, yeah, they're going to be borrowing a little bit more. It helps with the rate coming down so that their overall payment doesn't go up that much more. And because it is going to go up a little bit regardless. But really what we're talking about, the big kind of movement here is the addition of mortgage insurance. And we're talking $39 a month, you know? And so then it becomes, Mr. We can make this work. You can come to the table and bring that additional $10,000. You can kind of soak that in because now I guess if we're talking about, we would reduce the seller credit, right?
We're going to have
Is
to
that in this scenario?
Yeah, they're going to have to be at 75,000. So roughly.
Well, no, I'm saying, is that going to be part of this negotiation? Because the seller is going to say, we're asking for an additional 20,000 on top of the 30 that we're getting. Is it just the buyer's just going to bring the rest in that
Yeah. So
scenario?
what we're doing in this one, let's run back this scenario. So, hey, we want to keep our same deal structure. We'll pay 500. We want our 6% towards concessions, and we need to account for, and they came back and said, we'll do half of it. We'll do another 10, right? So this is kind of where it gets fun is we're going to figure out where do we place that 10. We're going to bring 10. They're going to bring 10, but we're not really bringing 10 if we just drop our down payment, right? We're just freeing up $10,000 for us to use after closing. Okay. Follow? That makes sense, everybody. We freed up cash that we were going to have to bring that now we don't. Okay. 2 on this. Sometimes, and I think in this scenario, it looks to be true. Our rate is actually lower with MI at 15% than it would have been without MI at 20%. And a lot of times that is true. Not always, but sometimes that is true. So you might even and eventually that MI will go away. They'll still keep the rate. Now we're trying to think about their $10,000. So here's my proposal right here, right now. Hey, Mr. Listing Agent, you guys are good for another 10. How about this? We're going to go to 490. So let's go drop our price. We're just going to reduce the purchase price by 10 grand and we'll make up the other 10,000 after closing. We'll figure that out. Keep everything else the same. And then Matt's got to figure out how to make sure my 6% or whatever I brought. Because I guess it would be a percentage that we negotiated the first time, not a flat fee. So we would now be reducing that a little bit. Let's go take that down to 6% of 490. There we go. Let's look at our terms here. So we're going to be bringing 75,000 total as a down payment.
Yeah. So we're talking percentages. So lower purchase price 490, 15% of that is 73.5. Cash to close now goes down to 74.6. So you're fine because you're not eating into your down payment at this point.
I want to challenge everybody too. Think about yourself, put yourself in the seller's shoes as well. What happens when we reduce price on the seller side?
You're taking away money taking away $10,000 on top of all the concessions.
Yep. Some of their closing costs go down a little bit. It's not exactly dollar for dollar, but they do. There's a little bit reduced cost there. Let's look. Can we go look at the like the cash to close breakdown on this one, Matt? Go to like fees or all right. Let's go down to the bottom. I just want to see the kind of with our credit what that looks like. So total closing costs are at 30.
And you're getting the max amount, 6%. So it's essentially still covering all the closing costs minus $900.
Got it. So we've in doing this, in this somewhat hypothetical trying to negotiate this thing scenario, we have been able to cross this bridge, right? A bridge that we crossed because we brought creative solutions to the table. Now, what hurdles do we still have to overcome? We're just doing inspections right now. What's next? Yep, Myra, shout it out.
So this is interesting that I was talking to my husband saying, well, we're talking about, money and, buying a house, my friend, how to help her like with the situation, negotiating with the listing agent. And in the end, it's like, I told her like, she's like, yeah, because my buyer, my seller wants this. And like, and bottom line is that the money, who's coming with this money, who's losing is the buyer. The seller is not. You have a number that you expecting to get from your property, but the only person who's coming with money here is the buyer. So why are we not negotiating? This is the person who's had the money. This is not your seller, or your seller's not losing anything. He's trying to sell a property for this amount of money and it's a fictitious number. You don't know who's going to pay for it. My buyer is paying for it. And that was my argument. Like, the only person who's losing money here or not is the buyer. He's the only one who's coming with any money to buy this property. And so she's like, she got quiet and she's like, you're right. And that's when, like negotiations. And like, to me, it's like putting it that way. I never thought about it. And it's true. The only person who's coming with money here is the buyer.
Well, yeah, to sell something, you got to have somebody writing a check, and the two that we got to remember, the two that are writing a check in a situation like this is the buyer and the lender. And so sometimes the lender is going to have requirements that maybe if you just had cash, you wouldn't have to deal with appraisal and all these things, right? But you don't got no cash, right? so you've got to work with the lender well to make sure we're able to carry these things out. I just want to pause here for a minute because we did a lot of kind of manipulating a loan scenario breakdown, fees, closing costs, all the rest. Are there any questions? Like I want to hear. I want this to like sink in. You don't have to know all of these things, but I want you to be confident enough to start asking questions. If you're on the seller side and the other lender's calling you and saying, this is all we can do, it's the only way we can do it, you've got to be, you can't feel like you are taking orders from someone. You've got to be confident enough in the way in which the numbers flow to be able to ask good, solid questions and yield outcome for your buyer and sellers.
What's the options that she said? Because you said like after the deal is done, we can make up that $10,000. Just like as a new agent, I'm curious what that looks like and what's like within. I'm assuming there's like legal boundaries of what you can and can't do, or
oh no,
I don't
I'm
know.
not suggesting anything like that. That would cross into that line. I'm saying that the $10,000 we're making up that we needed, it was done by reducing the down payment in that purchase price scenario. Now, it's not like it's not made up money. It's money that the buyer doesn't have to come up with at closing that they'll be able to then reallocate to after closing expenditures. Does that make sense? They've got $100,000 to play with And now they're only having to bring 75.
Gotcha. But we renegotiated a new deal essentially, right? By the the original deal, from my understanding, is 500. Now we
Yep.
renegotiate for 490.
Yep.
Let's say the seller is stuck on that 500. They do not want to move from that 500. How do we like negotiate that if they don't want to go to 490? Is there a way that we can make that $10,000 up in the deal itself?
We'll say, I would say same thing. If they said, hey, we're done at our deal, and the buyer says, I actually like the house for that, for my $500,000 with 6% in closing cost, I still like the house for what we've negotiated. Then it comes back to us to solve. We can either walk away or pay for the repairs after closing. Like there's really only two options there. So then you're backing into the question of how do we pay for it after closing? I got no extra cash. I've got one solution for you. Let's reduce our down payment to 15% versus 20, and now we've got an additional $25,000 to play with. How's that sound? Sounds great.
And whatever money's left over too, couldn't they just put that towards the principal, and then that would help accelerate how long they pay that PMI for?
For sure, but you're talking on the 25,000. What are we talking? 75 or $100 a month, something like that. I mean, it's going to be somewhat inconsequential to their overall financing scenario. And
I'm
you-
saying like when reduce it to 50%, does it change anything from the loan? Let's say if the loan was 20% and you change it to 15, the numbers they're not changing.
They are. Fine, not a lot. I mean, obviously, the loan amount's going up because they're putting less down, right? So that'll change the numbers. As we kind of saw in that scenario, the interest rate got a little better, so that helps with that as well. And then, of course, the mortgage insurance payment is going up. So, and then the big advantage though of the change is the cash to close went down by a large amount, and so that allows the seller, or I'm sorry, the buyer now to absorb some of that, $10,000 or whatever, they negotiated. If there was a $20,000 ask and the seller said, I'll cover 10 of it, then really the other part of it could be low, like we did, lower the loan amount, or if the borrower want it. And again, it kind of comes back to this too, that I don't want to get it lost in this, is some of those things wouldn't have to be done if these things that this $20,000, let's say it's just one item, let's say it's a roof, it has to get done, right? So it's not like we have the option for the seller to, or the buyer to do it afterwards. This has to get done, right? So in that scenario, yes, you can lower the sales price, but and that would kind of, the the seller in that regard is making $10,000 less, but then it becomes, okay, well, where's the buyer paying for that amount? And that, in this scenario, then we would lessen the seller credit, by that $10,000. So it would go from 30,000 to 20,000, right? And that is their contribution is essentially less of a credit that they were already getting, right? And so in that scenario, then that is where, we would see both parties kind of do something. Lower sales price that shorts the seller 10,000, lower the credit that shorts the buyer 10,000, and now the seller at that point now needs to fix it, right? You've got your 20,000 seller, right? Because now you're not giving me 30, you're giving me 20 as the buyer. You're making $10,000 less. Now you're going to need to go in and fix the roof, and then we can close. And so it is important to understand some of these things just have to happen before we can close. Some of them can happen afterwards, and then it becomes, and those obviously we have a lot more flexibility with.
And I say, too, Matt, are you able to pull up quickly, like how the payment changed? 'Cause I think that'd be helpful. Because this is the stuff, guys. Like this is the stuff that I loved about real estate, right? Like this is how I sold real estate. This is like creating deals and solving problems. I think too many times I'm on calls all the time with listing agents trying to stick up for their seller, and buyers agents trying to stick up for their buyers. And the truth is, like, you have to, I think Omar said something about like, oh, it's just my buyer. Well, like if someone buys a home and the roof is 15 years old or 17 years old, and they knew that going in, right? Well, now they're in a situation where they're buying the same house that's going to have a brand new roof, right? So some of the conversation with the buyer has to be like, well, let's just speak honestly here. How much more would you have paid have you known it had a new roof? That's amazing, right? So like Like, I think like breaking it down into always like what changes in the payment, like I'm in the middle of a transaction right now, and every conversation I have with the buyer that I'm representing on the loan side is like, hey, just remember, we're talking about, $1,000 difference in appraisal price. All we're really doing is changing your payment by about $65 a month. So based on all the houses you've been searching for, you told me how much you love this one. Is it worth the $65 extra a month? I'm not even asking yet, like, will the seller come down to the appraised value, right? So I think like looking at the monthlies and showing them like side by side would be like really helpful for people to see.
So, okay, so we're looking at a 3,320, let's call it $325 monthly payment in the new negotiated price, right? We've reduced the price by 10,000. Borrower's now doing 15%. So we've got mortgage insurance, 6.25% rate. Now let's go back to the original kind of before we knew about this 20,000, right? To see what happened with the seller or with the monthly payment. And I'm going to just manually remove that. And let's just say the rate stayed the same. I mean, because the rate's not going to make a big
Yeah.
difference on there.
Yeah.
But we're now looking at a new or the original monthly payment of 3,100. Let's call it $85. So 3,180.87. So you're looking at a delta between those two options at right about $140 a month for us to make that work.
$140 a month, right? And the cash to close was basically just the roof cost of the roof.
Yeah, you keep 5,000 and you pay $140 a month. I think
Right.
that's a pretty good trade-off.
Because that times 12 is what? $1,400 a month. That's how you break these things down for people, guys.
Because Jeremy, to your point, somebody is also very willing to replace a roof and start paying some creditor for that roof replacement. They do it all the time. Buy now, pay later, right? How much do you think they're going to pay more or less than they would on a 30-year fixed loan scenario?
Yeah. The payment's going to be
significantly more. You're going to be paying double-digit percentages on an expedited term. That new roof.
Yeah.
So like when people start thinking about that as like how this is a way of funding effectively a house that you can walk into with all of these new features that you're not going to have to touch for the next 5 years, 10 years, 15 years. It's a no-brainer, but people don't see it that way. And I would just say this because I love to flip to the seller side, and I'll speak truth to Mr. Seller here. Why do I have to come down off my price? Because you've avoided fixing depreciation on your house for the last 15 years. You've avoided fixing your roof and your electrical and your plumbing that needed to be done 15 years ago. You've been paying extremely high insurance rates, and now you're sitting here trying to command market price, for your house. And so like everyone's got to come to the table and say, hey, it's going to be good for me because I get all these new things. It's going to be good for me. I didn't have to spend that money 10 years ago. And so we're just the ones here saying, hey, how do we help get this thing to the finish line? They like your house. They like your location. They're not willing to make up for your avoidance of maintenance for the last 15 years.
The other thing we didn't even talk about is the fact that you're going to, in this scenario, if we're talking a brand new roof all of a sudden that we've talked about what the changes in the monthly payment, but how much cheaper are they going to get insurance now because they've got a brand new roof, right? And going forward, that's going to be a monthly thing that they're going to save going forward. So from the buyer's perspective, yeah, pay a little bit of money. Now you got a brand new roof. You're going to save over here on insurance as well.
Yeah. I love that point. Like that's how sales close, right? Yeah, the worst thing you can do is let's ask the seller if they can put on a new roof. And that's how the negotiation starts, right? Like these conversations should always be, hey, exactly what Matt was saying. Maybe your insurance goes down $75 a month. What would you have paid for the new roof? Let's see what we can work out. And then my job will be to find something that's great for you. And then we'll see what the sellers are willing to negotiate with, right? Like it's always start selling your own people first and then like figure out those problems. Then let's get everybody to the table.
One question to you guys in this situation when you're negotiating, and what will be the easier way or to get money first closing for the buyer? Like, what is the first things that you guys will do to ask for that? In what situation? Like in what situation? I know like the situation I had, it was like the house had multiple offers, but in a regular situation, what would be the number one key for you guys to ask for closing costs for the buyer?
I'll just say, I think we've got to first establish our parameters when we're entering a negotiation. If buyer has they're putting 3.5% down and they have no cash, they have to have closing costs paid for. And so for you as an agent, like that simplifies my negotiation. I mean, it's not like here's 6 ways we can skin it. No. Like we can't buy this house without closing costs. And so in those scenarios, it's an absolute necessity. You get to the problem when you have somebody that's like, I'd rather limit my out of pocket on this house. I've got the money to do it. Right. That's a different scenario. And so you're really just trying to navigate that. Like, is that important to them? If that's important to them, like, you just got to talk through that. What are the benefits, the pros and the cons? We could lose the house by asking for that if it's highly sought after. So it's not like something I don't get to twist the arm of the seller and force them to sign anything. Like I've got to present a deal that is generally acceptable to them.
Yeah.
Justin, let me ask you a question in terms of like this whole scenario. What if you have buyers, you're going into it, you see this house and you look at it just because you do this all the time and you're looking at the roof and you're like, you know what, that roof might be an issue. And then the buyer in this new scenario is putting the minimum down payment. They're not putting 20% down, because the only reason this worked in this scenario is because we could lower the down payment amount and increase the loan amount. But what if we're looking at they're first time home buyers and they're doing 3% down? We can't go any lower. We can't absorb it in any way. Instead of asking for the maximum seller concession, knowing that there's a good chance the roof is going to be, would you, as a seasoned buyer's agent, would you almost save some of that, knowing, hey, we may need to ask for additional stuff to get a new roof? Or would you go into it full, well, in this case, if they were minimum, you would only be able to get 3%, but would you ask for the full amount at that point, knowing you might still have a roof to replace?
So I had two things I live by. One, I don't want my buyer's mindset, and same thing when I'm on the seller side. Like I want you to go in with as much information as you can to that initial negotiation, right? So if I know if we're confident roof is going to be an issue, let's address it on the front end. Sometimes the seller's gonna be like, well, we think it's got enough years of life, you'll be able to get insurance, and then we have that conversation. I don't like having that conversation and then going in and then asking for it just because I was going to anyways during inspections, right? I don't want to tee up a future inspections discussion that I could have now. Like I have more power now. I've not spent any money yet. I'm looking at it, for my buyer saying, hey, this is something we're going to have to address. Like, I mean, you either, and Mr. Buyer, like you either get it accounted for now or you do it in 3 years. Like, it's not like it's not ever going to be an issue. It's going to be an issue, right? So that would be one. Is like if I can see something during our initial walkthrough, I don't want to plan on negotiating that later. Same thing. People come back and they say, well, it needs paint and floors. I'm like, you saw that the day you walk through it. Like that's not you're not doing your duty, right? That should have been accounted for in your offer. And then I had a second one that I live by. I forgot what that one was, but that would be, I would want to have that discussion up front. I know what it is. The other one, and this is a completely contrary to that, is sometimes if there's multiple offers, the person who gets under contract is the one who gets it to the finish line. If you don't get under contract initially, you don't get to the finish line. So like if there's going to be if I know that all of you are writing offers on it and half of you are asking about roof and concessions, all these things, like to some extent, like Mr. Buyer, let's try and get it under. We'll see what the report shows, and then we'll be the ones to try and negotiate it from there. If you really like this house, like we can't focus on 2 weeks from now. We got to focus on right now. And if we're not under contract, we don't get a chance to even be a part of that discussion. Because who's ever seen a multiple offer scenario that then goes under contract and sells for $15,000, $20,000 lower because there was inspection and appraisal related issues? Like I've seen it a lot, and I'm like, well, we would have paid that for it. We probably would have paid more than that for it.
Mm-hmm.
So it's all scenario dependent, but we want to be able to help our buyers really understand these things at the right time and not overwhelm them with future what ifs scenarios all the time, because I think they can get very overwhelmed. But it's funny because then we talked about that, like you said, like you're going to actually, in this scenario, you're going to go to a lower rate. You're going to save more than your MI premium in insurance. And one day that MI premium is going to disappear and you're going to keep the lower rate. Like that actually just sounds like a better scenario overall anyways, which is crazy.
I want to go back to what Elmira said too. Everyone's confidence, like on the buyer side, from the realtor to the buyers, most importantly, and the lender. It all stems from knowing exactly what the home is worth that you're purchasing, right? Like I always think about like the Tesla experience in buying a car. A lot of people love it, right? Because there's no negotiation. You know exactly how much it costs. All the information is right there online. Well, 95% of buyers agents are not doing real market analysis and comps on properties. So they're looking at the listing price as the way to gauge where they're going to start doing their estimations. Where like when I look at homes and I don't care what it's listed at, like I'm doing my own CMA based on the home, the square footage, I'm making adjustments. So with buyers, right, one thing they can count on is that you know how much this home's actually worth. We're not really worried about what they're listed at. So to answer your question on like seller concessions, I've had buyers all the time put in over asking offers and ask for seller concessions. And I've had buyers put in under asking offers and ask for seller concessions, right? Because it's not about getting the deal done just to get yourself a deal. It's right. It's always about, hey, this is what I know the home's worth. I'm not right, all the time, but I'm right 95% of the time. So here's where I think you should offer. Right. But it starts with that. And then all your confidence builds from that.
But you just got to know if you are going over and above what you think it's worth to get concessions, be prepared that you may have to renegotiate those concessions. Right. I mean, it's just a reality. Because if I'm seller, I'm saying, I'm willing to give them to you. I'm not willing to give them to you if we lower the price, a lot of times. You just want to see downfield and see all those scenarios. But we are at hour 10. So we're going to wrap it up here. Any final questions? We'll leave it open here for just a minute, and then we'll shut this thing down. I think this was fun. We didn't get to the end when the buyer buys a truck and then ruins the whole deal. I had that in our potential scenarios. After all of that, guys, thank you for hope there's something here you take away from it. None of these things become you've just got to be willing to learn and adapt, right? And you start to figure out that there's only so many ways to break it down, where the money's coming from, who can pay closing costs, how many closing costs can be paid. Everything has its limitations. And so you're going to become more and more comfortable, I think, over time as you play with this. I'll just say for me, this comes from staying up late at night and running my own scenarios and spreadsheets and stuff and be like, oh, I get it. Finally, there are hard stops and all how we can structure it. So, but when you become confident, you're going to be able to put deals together you wouldn't have otherwise, for sure.
Awesome.
Thanks, everybody.
Thank you all.